Today, we will talk about buying on margin, how it's done, risks and rewards. Buying on margin occurs when an investor buys an asset by borrowing the balance from a bank or broker. For example, an investor may pay 10% down and finance the other 90%. The investor uses marginable securities in their broker account as collateral. The Federal Reserve Board sets the margin securities. As of 2023, an investor must fund at least 50% of a security's purchase price with cash or other collateral. The investor may borrow the remaining 50% from a broker or a dealer. Brokers may set higher margin requirements for their customers, and some securities cannot be purchased on margin. As with any loan, an investor must eventually pay back the money borrowed, plus interest. Consider an investor who purchases 100 shares of company XYZ stock at $100 per share. The investor funds half the purchase price with their own money and buys the other half on margin, bringing the initial cash outlay to $5,000. 1 year later, the share price rises to $200. The investor sells their shares for $20,000 and pays back the broker the $5,000 borrowed for the initial purchase. Ultimately, in this case, the investor triples their money, making $15,000 on a $5,000 investment. The broker sets the minimum or initial margin and the maintenance margin that must exist in the account before the investor can begin buying on margin. A maintenance margin is required to be retained in the investor's brokerage account. If the investor's equity dips below this maintenance margin, the investor may receive a margin call and will be required to deposit funds to bring the balance in the account to the required maintenance margin. If the investor does not comply, the broker may liquidate the investor's collateral. Buying on margin requires a certain amount of risk tolerance and should be closely monitored. Generally speaking, buying on margin is not for beginners. However, for skilled traders, it represents an opportunity to exploit market opportunities, even with relatively limited investment capital. Here are 3 key takeaways. 1. Buying on margin means you are investing with borrowed money. 2. Buying on margin amplifies both gains and losses. 3. If your account falls below the maintenance margin, your broker can sell some or all of your portfolio to get your account back in balance. Hope this would help. Thanks for watching.